video on some basic accounting principles that should help you understand what accountants are talking about and what they're doing when they play around with figures. The first example we've got on the screen here is just a very simple scenario of Tatsa coffee shop. So we're just trundling away each month. Things are pretty steady. We've got an income of $7,500 a month each month, and we've got expenses of $5,000, food, wages, etc., overheads, leaving us with a profit of $2,500 a month. Okay, that over time leaves us with $30,000 per year. All right, and what we're doing here is we are recognizing the income and expenses at the time they are received or spent. A very simple way of running your books. Okay, that's an important term. When do we recognize our income and expenses? Let's move forward to more of a real life scenario, a real world scenario. We'll leave the income and expenses as they are in the previous example, but we have some things that have happened on top of those very straightforward income and expense amounts per month. So in March here, we've got to pay the insurance bill for the year all in one lump. That's $5,000. Something broke down and we have to replace some equipment. So that was $4,000 in July. The following month, someone's resigned and we need to pay them out what's owed them for their service to date. Another $3,000 out the door. And then it's been planned for some period of time and we've done it now, and in October we are paying for our fit out. So some of these things can be planned for, some are unexpected, and they're quite lumpy amounts of money. What that does to the business over the 12 months is that obviously it changes the profit per month, and overall it was a $2,000 loss for the year. So looking at the graphs here, we can see we're trundling along as per usual in the first couple of months. Then we make a loss, then some profit, then another loss, then a small loss, then a bit of profit, then a lot of loss, and some profit and profit. So looking at this graph, it's not easy to understand where we stood for the whole year. And as we're going through the year and we're making some profit and some loss, if you get to a point like here, it's not very easy to understand where you're going to be at the end of the year, and it's not very good for planning. Okay, so our simple rules for recognizing income and expenses at the time they are received or spent doesn't serve us very well. It's not very meaningful. It's simple but not useful in this scenario. So our accountant friends have come up with some techniques to modify the figures and how we recognize income and expenses over time so that we've got a more meaningful report and understanding of where the business stands. Okay, so the previous example was using cash accounting, recognize income and expenses at the time that they are spent or received. Cash accounting. The following example is the exact same business, exact same expenses, but we're going to use accrual accounting so that costs and expenses and income can be accrued over time. Okay, but it's mostly focusing on costs. So when an accountant says, I'm going to accrue that, that means they're going to spread it over the useful life of that asset, a tangible or intangible asset, okay? So we'll go over the rules first. Cash accounting rules, excuse me, that's meant to be accrual. Accrual accounting rules. Recognize income and expenses at the time they are spent. We can still do that, or we can use these other methods. We can accrue income and expenses over time, recognize them at different times, spread them out. We can depreciate capital expense over its useful life, 3, 5 or more years, which will be handy for the fit out. We can amortize intangible assets over the cost of the asset over its useful life. Following a defined set of rules called the Generally Accepted Accounting Practice Rules. Okay, so there are rules around this and you need to look them up. Okay, so what have we done here? Let's go, we can leave the standard income and expenses as they are. We'll just go through the 4 lumpy expenses that happened during the year. The insurance, its useful life is 12 months, so we can spread that over 12 months. So instead of being $3,000 for the year, it's $400 a month, which is a bit more palatable and gives us a better idea of what we're actually making per month. Okay. Equipment expenses, well, we didn't buy the equipment until what was it, July, and we're going to be using the equipment for some period of time, so we've chosen to depreciate that piece of equipment over 36 months, so 3 years. So that's only costing us, in an accrual accounting sense, $111 a month, which is great. Okay, a lot better than the $4,000 up front. Long service leave, we're going to treat that very simply and we're going to expense that. So we'll recognize that straight away, $3,000 in that month. There are some more sophisticated methods of accounting for that, but at Tat's Coffee Shop, we just want to keep things as simple as possible, and it's not too large an amount of money, so we'll just recognize that right now. And then the new fit out, that was quite a large expense, $20,000. We're going to write that off over 5 years, depreciate it over 5 years, which is only costing us $333 a month. The fit out could last longer, but the generally accepted accounting rules want to keep things straightforward and allow people to manage their business sensibly, so they round it off to 3, 5, and in some exceptions you can write capital expenses off over a longer period. Okay, so what's that done for us? Well, the graph looks a lot more understandable. We've made a loss in 1 month, but that was because someone resigned and we had a large expense in that month, and that's easy to understand. It's easy to understand why that happened, okay? And it's an anomaly, and it's not going to happen that frequently, okay? Now, our profit there in an accrual accounting sense has gone back up to $20,000, so that's a lot better than a $2,000 loss. So you can see from this example that when you're working in a real-world scenario, you're going to need to spread the costs over time to get a better sense of what profit your business is actually making, and to recognize the cost of some large expenses over their useful life. That's what accrual accounting is for. Okay, I hope that helps and demystifies some accounting terms for you. Put them into practice, start using the terms at work, show off how much you know.